Indian banks are facing their worst deposit crunch in nearly 2 decades, and the new draft guidelines from the Reserve Bank of India are set to add even more pressure. Starting April 1, 2025, banks will be required to hold more cash for deposits made through digital channels like online and mobile banking. Let's first understand what these new norms are. Banks use something called a runoff factor to estimate how much money might be withdrawn quickly. Think of it like a safety net. For stable deposits like saving accounts access to online channels, banks will assume 10% of this money could be withdrawn quickly, up from the current 5%. For less stable accounts such as checking accounts, the runoff factor will be 15%. This means the bank anticipates that 15% of these deposits might be taken out quickly if access to digital banking. In short, if you're using digital banking services, banks expect a higher chance that you might withdraw your money fast. As a result, they'll keep more cash on hand to be prepared. Now let's dive into what these new norms mean for both banks and you as a consumer. For banks, these new rules means they will need to hold a larger portion for their funds in liquid, low-yield assets. This is essentially money that doesn't earn much interest like cash or government securities. The downside? The shift will cut into their overall interest income. In simpler terms, banks will earn less money from their assets, which could squeeze their net interest margins or NIMs and lower their overall profitability. To manage these new liquidity requirements, banks might slow down their lending activities. Instead, they'll focus more on investing in government securities, which are safer but offer lower returns. To attract and keep deposits, banks could raise fixed deposit rates as well. While this might make fixed deposits more appealing to you, it could also add to banks' costs. So what does it mean for you now? On the positive side, you might benefit from higher returns on fixed bank deposits. Banks needing to attract more deposits could offer better interest rates on these accounts, which could be a win for the savers. However, over time, if banks find their profitability squeezed by the increased liquidity requirement, they might lower FD rates to manage their cost. Moreover, the increased liquidity requirements means banks will be holding more cash to cover potential withdrawals. This can make your deposits safer because banks will have a bigger buffer to handle sudden withdrawal demands. There's a trade-off, however. With banks needing to manage higher liquidity and slower lending, you might find it a bit tougher to get new loans. Banks might tighten their lending practices to align with the new rules, which could make borrowing more challenging. While RBI's new guidelines are aimed at making the banking system more resilient, they will have immediate and broader effects. Banks will face pressure on their profits and lending practices, while you might get better returns on your savings but could face more difficulty in getting new loans.